Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. This is 15 Minutes of Finance. This is the news cycle. We've had the craziest last couple of weeks for October. Okay. Historically, October is a terrible month for the stock market. November's pretty much the same thing. And then December, everybody sells in their brokerage accounts to get tax losses. So usually December, it's always a bad month. Or not a bad month. It's just a predictable down month, right? But now I don't know. I don't know what's going to happen. Everything's up in the air, guys. Everything's up in the air except for long-term predictions. Okay. That is a pretty consistent thought process. So today I wanted to do multiple things, but mainly focus on two big ones. I wanted to talk about, eventually we have to, Brandon and I will probably do it. We'll talk about the tax implications of each presidential candidate, right? What happens if Trump gets in? What happens if Kamala gets in? But today I really wanted to talk about, or individually I'll talk about how I think each candidate's, I don't even know, you would just call economic plan, how that will affect the stock market. Okay. Today we're going to talk about Trump's, just because I'm more familiar with Trump's, because everybody's talking about it. Kamala hasn't really nailed hers down yet. It's still a little bit up in the air. But Trump is very like, this is what we're doing. This is how we're going to do it. So it's a lot easier for me to interpret and cycle through all of his information. But also, like I said, there's volatility, right? And one of my increasingly favorite researchers, basically just an analyst, Tom Lee, he's the head of research at Fundstrat Global Advisors. I don't fully know. I mean, I've heard of Fundstrat. They work mainly with really, really big RIAs. So like, or investment firms, doesn't have to be an RIA, but people like us, but they have billions and billions of dollars under management. These people will sell their research to them, and then those people will thus invest money based upon Fundstrat's research. And I've been saying it now for years, but I don't know what the S&P 500 is going to be. It's just going to be higher in the future. Well, Tom Lee takes the most aggressive approach I've ever heard, and I kind of like it. And the reason it goes hand in hand, because if Trump gets in and his plan works, I could see how in 2030 the stock market is where Tom Lee says it's going to be. And it's probably best if I just read the interview question and then Tom's answer. So he was interviewed by Bloomberg a couple of days ago, or I don't even know if this was weeks ago. It might have been a week or two ago. But so Tracy's the interviewer, and he says this, and then I'll read Tom's response. He says, here's something I always wanted to ask an equity strategist. But when you're coming up with the price targets, do the specific numbers actually matter for your clients, or are they mostly interested in the direction, the overall direction, like line go up, line go down? And Tom said, sure. Well, this is a lifelong debate, because for 30 years I covered wireless stocks and I had price targets. And our salespeople would always say, no one cares about your price targets, Tom. But then first thing in the meeting, people were like, where do you think this thing goes? So they always care about the price target. I don't really value people's price targets, which are 10% where you are now, 10% above or 10% below where you are now, because to me, that's like staying in the middle of the lane and you can't make clients money. So whenever we did stock research, we always had to build a base case and what we think would happen, what we think could happen, and then discount it at what we think is a reasonable rate. A lot of our price targets seemed really crazy when we did wireless. I remember when I upgraded, you can timestamp it actually. I can show you Alamosa Holdings at 21 cents and it went to $22. First off, crazy. Great job there, Tom. That's impressive. My price target was not 30 cents, it was $12 at the time, and we upgraded Western Wireless to $1.74. Our price target was $25 and it ended up going to $40. So I think we try to look at a normalized situation, and in a normalized world, if this is a normal S&P cycle, okay, following demographics, I could provide a chart later. S&P should potentially be 15,000 should be potentially 15,000 by the end of the decade, so 2030. So to me, that's more, as you move into long time frames, that's probably where I think we're moving towards. And then Joe said, I'll take it. Can we title this episode Tom Lee, Why S&P Could Go to 15,000 by 2030? Is that cool? Tom said, sure, we have many charts to explain that number. Okay, so I know that was a hard listen because I was reading the transcripts from the interview, but that's Tom Lee from Fundstrat saying in 5 years, 3 months, right? It's October, November, December. Yeah, 5 years, 2.5 months. The S&P is going to be at 15,000. That is hyper aggressive. Every advisor I know or money manager, I'm the most aggressive one that I know. Now this guy's taking it 4 or 5 times what I said. So, I mean, this is pretty aggressive. And I just wanted to talk real quick about why that could make sense, right? So the whole point of this episode, why the S&P could be 15,000 by 2030. If Trump gets elected and if these tariffs come in, this is the whole big thing. Everybody's concerned about his tariffs, tariff this, tariff that. Okay, tariffs are widely confused and they're also unpredictable. Okay, you cannot say adding tariffs does X, Y, and Z. It just isn't, it's not 2 + 2 = 4. Now, with the way things are going, I can give you a good example of why I think the tariffs could be a good thing for us. So, initially what would happen? Let's just say Trump gets in, tariffs start happening 2025, probably get implemented 2026. Okay, that's probably the earliest it could happen because things need to get signed and then implemented and then there needs to be enforcement. There's a whole bunch of stuff. But the way a tariff works is it's essentially just hey, if you're going to cross the bridge and do business on our side of town, you need to pay us $10. Okay, that's essentially what a tariff is. And the reason why that's not that big of a deal is because countries all over the world have tariffs. That's how a lot of countries make money. That's how we, for the first 200 plus years, made money as a country. Because we were a big consumer back in the 1800s when we became a country, and other countries were like, we got to go to America and sell. Okay, so we charged tariffs. It's not uncommon to do that. Now, I will say, almost every other country that we do business with has tariffs. Let's just use the car industry. Okay, you don't see Ford vehicles, you don't see Ford Raptors in Europe, okay, because the tariff on that is like 100%. So a Ford Raptor, which is probably, I mean, I guess I don't really know my truck prices, but I bet it's $80,000. That's $160,000 over there. No one's buying $160,000 vehicle in Europe. Even though they might like Ford Raptors, they might like the way that those trucks looked, or F-150. Those things just, the tariffs in other countries make it hard for us to sell stuff in those countries. So the reason, just using that as an example, we don't actually sell a lot of American-made stuff, big industry items, in other countries because those other countries tariff us. So if Trump's tariff plan, which his thought process was, I'm going to charge other countries significant amount of money to sell things to America that we make here in America, okay? And there's only really 2 ways a country makes money if we're just using basic GDP, what a country creates as a nation, okay? There's only really 2 ways. One is they create something new in their own country, and then their own country consumes it and pays for it, okay? That's one way. The other way is if another country comes in and buys that good from the U.S. or from that country, okay? So it's either foreigner money or it's local money. Those are the only 2 ways. I mean, that's the only way to cut that cookie. So these tariffs would say, hey, if you want to sell your electric vehicles, China, in America, we're going to charge you a tariff. You're going to have to pay $10 to come across the bridge and sell us those electric vehicles. Now that makes sense because we have Tesla. Okay, we have Rivian, and there's a couple other ones that are not that impressive, but they exist. Those are American-made vehicles, or at least it's an American company. Tesla does manufacture stuff in China, but it's just an American company. So when we charge that money to these other companies, it does 2 things. One, it might limit the competition for American companies from foreign companies. And 2, it might create cash flow from other companies because they might say, hey, I still want to sell in America. Like, they're the number 1 consuming country in the world. That is why tariffs for us aren't the same thing. It's not like tax bad, we won't go there. Now that means that all prices are rising for American citizens. That's not true. We're the number one consumer in the world. There is incentive to work with us, and we just don't charge the same amount of money to other countries that other countries charge us to do business there. It just doesn't make sense. So the reason that explains the tariff situation in a bubble. I know that was a rant, but now the reason why it might be great for us is because maybe we have like, 2,500 really successful companies in America. There's a ton of small businesses, but I would say maybe there's like 2,000 to 3,000. So we'll say 2,500 really successful companies that could do business anywhere in the world. Okay. There probably could be 15,000 of those companies if we stopped outsourcing things. So when you put tariffs on other countries, it forces people to buy American made, or it incentivizes people, and it also incentivizes people to sell to Americans. Okay, so now we have 15,000 companies that are pretty darn good, and that's going to do multiple things. It's going to create jobs. It's also going to increase cash flow just within America. Okay, and I could see how that right there in and of itself could boost the S&P 500 to 15,000. Hopefully that makes sense. Now, there's a lot of things could happen too, where, the BRICS system is getting implemented. So we have Iran, Russia, China. I'm not sure. Turkey, I think, is getting involved with BRICS. I think, that cash flow system, that could cause some changes to how consuming is done, right? Maybe America's not the largest consumer anymore. Maybe it becomes India. Maybe China gets out of their crappy economic situation and starts buying things again. Who knows? I'm just saying I could see how the tariffs create jobs, increase cash flow, and shove that S&P 500 to 15,000. I mean, there could be nothing better for our company than to have thousands of companies competing for the S&P 500. That would be, phenomenal. That's going to boost the price sky high. So that's how I could see it happening. Okay, hopefully that makes sense. And guys, we want the market to go to 15,000. Boy, do we. I think it's trading at a PE right now of like 18, which maybe Tom said that in the interview. I can't remember where I got that number from. But remember, PE, you have to spend $18 to get $1. Okay, so if you're already in the S&P 500 right now and it goes to 15,000, you're basically, it's like 2.5ing your money, which is excellent. Especially if you want to retire in the next 10 years, that's the kind of number you want right there. Okay, the last thing I wanted to talk about, because we have 3 minutes left here, is I wanted to look up what does the stock market do in election years. Now, this is from First Trust, which, First Trust Portfolio LP. I don't really know anything about them, but they've got a colored graph here, and it looks legit. And it also checks with some of the information I've done. But their information, they have from 2016 all the way down to 1928, which, if you remember, the Great Depression was in the 1930s, and the Roaring 20s was like the best decade for the stock market ever. So this is a good little graph here to go over these numbers. But so the U.S. presidential election results, right? So when a Republican was elected, the average return for that year was 15.3%. Okay, we're at like 22 right now. When a Democrat was elected, it's at 7.6%. And then all election years are around 11.28%. So, a couple of things with that information. It doesn't give details of who the previous administration was. So, Democrat with a Democrat as president doesn't necessarily make sense, right? Because what if the Democrat president, it was like 25%. And then the next year it would make sense that it's going to be 7 because we've already had a great year in the past, right? These years, these boom years like we had to this year, they don't really consecutively happen all that often. I just don't. There's not a lot of track record for that. So that's why I don't like that data. It's not to say that when a Republican wins, it's twice as much as a Democrat. There's a lot of other factors that go in. But so like if we look at this, so in 1928, Herbert Hoover, which shout out Herbert Hoover, he was my president in third grade. I had to do a giant project on. And I remember doing the project and being like, Hoover Huts. Oh, that's interesting. That sounds like Pizza Hut. And then I did what any kid would do, and I made my project out of I designed it a clay Pizza Hut with the red roof, and I called it Hoover Hut. And then once I started learning about it, Hoover huts were actually like the TP makeshift homeless shelters that they would give to the people who lost their home in the Great Depression. So not the greatest design that I went with, but just shout out to Herbert for getting me all excited about Hoover huts and then finding out it was actually a homeless shelter. So in 1928, again, great decade for stocks, 43%. Okay, that was Hoover's last year. Actually, sorry, that was his first year. My apologies. And then in 1932, when Roosevelt got elected, it was -8. Okay, and then 1944, which was Roosevelt's last year, a whole big thing with that. I think he did 3 terms for a reason. Was 19.8%. Okay, then Truman got in, 5.5%. Roosevelt and Truman were both Democrats, and then Eisenhower got in 1952, Republican, 18.4%. So there's constantly going back and forth. Okay, then John Kennedy, 0.5% when he was in. Then 1964, Johnson, 16.5%, both Democrats. Okay, Richard Nixon, 11 and 19% each year he got elected. Carter, 23%, another Democrat. Reagan, 32%, Republican. Older Bush, 1988, 16.8%. Clinton, first year, 7.8%. Second term, 23.1%. Bush Jr., -9% in 2000. That was from the dot-com bubble. And then 2004, Bush's second term was 10.9%. And then Obama's term, first year, because he was cleaning up the ridiculous housing crash, -37% from Obama's first year. And then in 2012, 16% from Obama. And then 2016 with Trump was 12%. And then if we track his 2016 to 2020, very, very good years. Then the COVID year, I mean, it would show not, well, I think it would actually show positive because the COVID drop in 2020 was only a couple months, but it was a huge drop. It was like 20%. So I know I just rushed through those numbers, but I just wanted to show you, like, it's not rocket science. Like, it's not, well, rocket science is probably not predictable either, but it's not, what's a super predictable science? I don't know. None of them are probably predictable, huh? Anyways, it's not predictable math. Okay. It's not 2 + 2 = 4. And I don't really know how much the election year stock market matters so much as the year after, which it's almost always less. Okay, I did a little bit of research, not a whole bunch, but I think it was something like 90% of the time. The return the year after is always less. And we'll go over Kamala's, she's probably not going to have any tariffs, but her plan for the economy whenever she solidifies that here in the next couple of weeks, we'll explain how that would affect the markets, right? So again, with Trump's plan, at least with Trump's, I could see it being immediately not positive. So we're talking 6 months. If he comes out and he really does hit home with these tariffs, like he's saying, it will affect things immediately. But don't miss the forest for the trees, okay? Or don't miss the trees for the forest, whatever the saying is. Don't get caught up in what's looking right in front of you when you can see the whole thing, right? You can take a bird's eye view and see the whole thing. If we go down 15, 20% in the first 6 months of this year, but then in 2030 we're at 15,000, you're going to say, wow, I wish I would have bought more. I wish I would have bought more February 16th, 2025. Okay, I promise you that's what you'll be saying. So, yeah, just take all these things in stride. And remember, the S&P has volatility up and down, but it trends upward. Okay, and if we can go to 15,000, I mean, this might be one of the best decades ever. I mean, well, it probably wouldn't be a decade, huh? Because the first 2020 to 2023 was pretty brutal. I mean, half a decade, I guess. That could be kind of good. But anyways, very good for people, especially who are in that 10-year window to retire. Get out of target date funds, okay? You do not need to be in a target date fund. You can isolate your own investments, okay? A balanced fund. You can do a conservative fund and then have a chunk that is aggressive. If you're in a target date fund and you have less than 10 years, they are putting you in bonds. You do not want to be in a bond right now, okay? The next 10 years, my advice, my research, I guess is what I would have to say, is that bonds are going to be stagnant or not be very good. Okay. And when you get a bond, the people that are selling you the bond are putting it in the market. They're investing in equities. Okay, it's the same thing with annuities. It's the same thing with insurance. Anytime you give somebody money, all they're doing is saying, let's go invest it over here because we know we can get more return. Okay, they're betting on the long term and they're betting that you're scared. So don't be scared. All right. Now, if you've got less than 5 years, 10 years, definitely speak with a professional. Be on top of this stuff. It could be the difference between $100,000 and $1 million. In some situations, it could be even more. Okay. Guys, I keep running over this time here. I just get too into this. As always, guys, invest early, invest often. We'll see you next week.